Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different idea from the financial landscape and attempt to apply the teachings of the man widely considered to be the founding father of the value approach, teacher and mentor to Warren Buffett no less. We are of course talking about Benjamin Graham. In this episode, we should be taking a closer look at the qualitative aspects to be taken into account when considering a particular stock for purchase. Qualitative factors include the quality of a management team, the strength of a brand, and any durable competitive advantages that a business might hold. Considering along the way how the value investor deals with these very important aspects of valuation to arrive at a confident conclusion. We'll be taking a closer look at all these factors, examining what a competitive advantage is exactly, using real-world examples, before considering how these can be dealt with in an intelligent manner. So without further ado, let's dive right on in. As ever, buckle up, sit back and get ready to absorb another lesson inspired by Benjamin Graham. I'm well aware that on this podcast we spend an awful lot of time focusing strictly on the numbers. Value investment is of course very much a quantitative game, and most of our time will be spent poring over the statistical exhibit that we will find in a business's accounts. This is not because the more qualitative aspects, those relating to the quality of a business, such as the general outlook and the quality of the management team, are not of vital importance when it comes to determining what price should be paid for a business. Rather, it is an acknowledgement that these aspects are not well suited at all to the scientific approach upon which our art is based. Numbers can be crunched and solid conclusions can be drawn from them, but factors around the general quality are much more open to interpretation and mere opinion than are the figures to be found in the company's accounts. If 100 value investors from around the world were asked to place a valuation upon a business based on the financial exhibit alone, it is highly likely that the conclusions drawn would all be pretty similar, certainly within the same ballpark. But if you ask 100 investors who base their decisions to invest on the qualitative factors to do the same, then it is likely that the conclusions drawn will be wide and varied. This is because they'll be forced to draw their conclusions from sources of information that is likely to vary greatly in its dependability. But of course, whilst anticipating the future is a near impossible task, that does not mean that we should forget all about the factors of quality when it comes to our decisions to invest. The approach I like to take to this problem is quite simple. The quantitative analysis, that is the study of the business accounts, should take place without any consideration of what makes that business a good one or a bad one from the viewpoint of quality. From this, I will decide what price I'm willing to pay based upon what I've discovered, baking in, of course, the all-important margin of safety. Only at this point will I consider what makes that business an attractive or unattractive place to invest from the viewpoint of the business's qualitative attributes. This will typically result in the instant exclusion of many businesses whose showing is substandard on this score. A company might well look cheap based solely on its financial showing. But what if the qualitative analysis throws up that that business appears to have no long-term future? It is conceivable that a video rental company like Blockbuster Videos could have looked cheap quantitatively a few years before its demise. But it didn't take a genius to realise the direction of travel for that particular industry. In this case, the qualitative picture should have invalidated the conclusion reached purely from the examination of the company accounts. In order to proceed with a possible investment, the qualitative aspect, therefore, needs to be either benign or a positive one. And this leads us to the all-important question. Should we, as value investors, be prepared to pay more than the figure arrived at from our quantitative analysis for a business with a particularly bright outlook? This is a tough one because clearly some value investors will be more happy to do this than others. Warren Buffett is clearly one who is happy to pay more for a business that appears to have great prospects, but others will be more circumspect to do so. I believe it comes down to this. Buffett, with his many billions to invest, only has a very small pool of businesses that will be big enough to absorb his capital and make it worth his while. So he's very unlikely, except maybe in a particularly strong bear market, to find a business that is both cheap from a quantitative standpoint and highly attractive from a quality perspective. But for the rest of us with our comparatively tiny sums available to invest, we are sport for choice, and it should be quite possible to find quality businesses at bargain basement prices in most market conditions. The average value investor, therefore, need not pay a premium for aspects of quality that may or may not work out quite as foreseen. A particularly strong qualitative showing would perhaps be a strong signal to invest more than you otherwise would have done in that business, but not necessarily to pay more for it. So with that said, what are the aspects of quality that we should be paying particular attention to? The quality of the management team is surely an important one, of course. But how do we really go about determining if they are truly good or simply lucky? And should we really be considering how excellent a management team is completely separately from the excellent results they achieve? Benjamin Graham, for one, considered this to be counting the same trick twice and thought it a common cause for overvaluation. And on top of this, we have the personal aspects. What if the CEO has got a little goatee beard? And I hate goatee beards. They wind me up. And can I be so sure that this is not going to affect my judgment of him, at some subconscious level at least, of his abilities as a boss? Then we have the outlook for the business and the economy more generally to take into consideration. Again, how can we really forecast what future economic conditions might look like? Who exactly could have foreseen the COVID pandemic, the war in Ukraine, or the current global trade war? And outlooks can change so quickly. Just a few years ago, the assumption was that Tesla was going to have this EV business all to itself. Then from virtually nowhere, it has been overtaken by China's BYD. Paying more for future trading conditions that by definition are always going to be unknowable is a fool's errand. The most important factor, I believe, from the viewpoint of quality, can be found in what particular competitive advantages a business holds. This is often described as a competitive moat, and it acts to protect a business against competitors and external threats. A classic example here is with the Coca-Cola company. Here you have a business who have built a brand that is so strong and so ubiquitous as to give it a virtual monopoly in its industry. Of course, it's not a monopoly in the true sense, in that we also have Pepsi and others. But if you want a Coke, nothing else is going to scratch that itch. If you want a Coke and you've asked for a Coke, but you're given something that looks like a Coke but isn't a Coke, you're going to know about it and you're going to be pretty pissed. Coca-Cola's sales, therefore, suffer no risk whatsoever from competitors coming along and muscling in on their territory. This lack of real competition gives Coke a massive long-term competitive advantage. And within reason, they can charge what they like for their product. If you must have a Coke, the fact that it's a few pence more expensive this year than it was last is not going to deter you from getting your fix. The same cannot be true of most businesses out there. If you have a business that makes those little springs you get when you dismantle a pen, one of my favourite pastimes, listeners, nobody is going to say, I'm not going to buy that pen because it doesn't have that little spring made by that company I like. Anybody can come along and make that spring, and you're not going to care so long as that pen works. The spring maker can't say, I'm going to jack up the price of that spring, because people just have to have our little pen springs. Anyway, that's enough about springs. So we can see that a strong competitive advantage is an exceedingly attractive qualitative factor to possess. And it certainly makes the business a more valuable one than if that competitive advantage did not exist. But here's the rub. We still have no way of placing a meaningful numerical value upon it. What Coca-Cola's competitive advantage is worth in dollars and cents is anybody's guess. And it's pointless even trying to tie that valuation down. And I go back to what I said before. Strongly positive qualitative factors, such as competitive advantages, are best dealt with by the value investor, not by increasing the valuation you've already arrived at, but by making the attractive feature a compelling reason to invest in that business. If I was to discover a business like Coca-Cola selling cheaply on quantitative grounds, the uniquely strong qualitative showing would not alter the amount I would be prepared to pay for that business, but what it would do is give me much greater confidence to invest more of my funds in that business than I would if that factor did not exist. The Buffetts out there, stuck with the handful of businesses large enough to swallow their capital, may not have this luxury, but for the rest of us, there is no compulsion at all to try and place a value upon these lovely features. There will be enough businesses to choose from, available cheaply enough, with attractive features pertaining to quality, to not have to venture into the uncertain art of qualitative pricing. I reiterate the quantitative conclusion drawn from the examination of the company accounts should remain the prime basis of what to pay for the stock of a business. The qualitative picture is best used to either invalidate the quantitative showing if the business is a particularly bad one, or to urge the purchase of that stock if the picture is a positive one. If two businesses look equally attractive from the viewpoint of the accounts, then the qualitative picture is likely to determine which one offers the best long-term prospects. The quantitative picture is important and knowable. The qualitative picture is important but uncertain. By placing prime emphasis on what is important and knowable, the value investor leave themselves in a better position to weather whatever the future throws at it. As Graham once said, the future is essentially something to be guarded against rather than to be profited from. On that, we shall draw today's episode to a close. I do hope you've enjoyed it and it has added a little something to your understanding of the Graham approach to value investment. If you have, please do consider adding to playlist. That way you'll be alerted as soon as any new additions land on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.